This episode of Bulletproof Cash Flow is brought to you by Realty Dynamics. Learn how people like you can build substantial passive income while creating wealth for the long term through real estate investing. Visit rdyne.com. That's RDYNE.com.
If the cap rates are slightly higher, depending on the property and property type, then guess what? Your basis, your price per square foot, you're getting in's lower. And, I've been in this business a long time. And a lot of times you look back at the historic history of your investments and what you bought and sold. The original cap rate may not be that important now, but it's really more the basis. Where you in at 100 a foot or 200 a foot? If you have less buyer competition and you can get in a better basis, then it can be, a good time when supply and demand at your benefit. And I think that's part of what's happened in the single tenant net lease investment market, where we're seeing cap rates really adjust very marginally.
Working because you want to, not because you have to, is financial freedom. And we want to help you create that. Welcome to the Bulletproof Cash Flow Show. We're going to teach you how to achieve lifetime financial freedom through real estate investment. Your host is a multifamily syndicator and property developer. He's done deals reaching into the hundreds of millions of dollars. You'll hear from experts in all aspects of real estate investment, finance, development, and management. Everything you need is right here. This is the Bulletproof Cash Flow Show. And this is your host, Augustino Pintus.
Hey everyone, it's Augustino. The commercial real estate business is changing on a daily basis. We got the rate hikes, got lack of inventory of the multifamily asset especially, and the pressure on office sector has put a damper on the hot market that was in full effect not so long ago. Now, today's guest has seen all the cycles. He is an expert in commercial real estate with over 35 years of experience as an active commercial broker. Now, with over $7 billion in closed transactions under his belt, his knowledge and expertise in the industry are firsthand and current. Now, he began his career at the age of 19, selling investment properties while attending Georgia State University. From there, he dedicated himself to studying best practices for commercial agents and perfecting his strategies. He became a full-time commission-only agent at the age of 22 and has since become a CCIM and active licensed broker in 8 states. Now, he is also the founder and CEO of Bull Realty and the host of a long-running podcast, America's Commercial Real Estate Show, reaching over 100,000 listeners each week. With all that, I'd like to welcome Michael Bull to the show. Michael, buddy, thanks for coming on, man.
Hey, thanks. I appreciate it. Good to be with you.
Yes, you bet. Now, guys, if you like what Michael has to say, you can reach him via his contact page at bullrealty.com. Okay, Michael, tell listeners a little bit about your journey. How'd you get started in all this?
So I started managing apartments during the day while I was going to school at night in college, and then got my license at 19. My first sale was a 20-unit apartment building. At 22, I dropped the management, went to full-time sales. I created a big market share, probably the biggest market share of any broker in town Atlanta for multifamily. Had a practice. And then 25 years ago, started Bull Realty to be able to work at a company known for integrity. And one was the only reason I started it because I really like just brokering and doing deals and helping clients. So. But it grew, and then we did 1.9 billion transactions a year ago, and we have about 50 people, and we do a lot of business around the Southeast U.S. and we're headquartered in Atlanta. So that's kind of my journey.
Yeah, Atlanta, hot market too. Atlanta, great market. I was just thinking about that market just the other day when we were in the green room talking about doing live tech and doing some other stuff as well. But before we go into that stuff. At the age of 19, very, very young age to be getting into real estate. And we talk to a lot of folks that often come onto our social media pages and are young guys that want to get started. Like, how did you get started? Because 35 years ago, or even longer than that, there weren't too many young people getting into this business, right?
Yeah, I don't know. I just realized I kind of lucked into that first property management job. And I really liked dealing with people and marketing and consulting, and learned how to manage apartments. We turned around apartments, bought stress stuff, and lipstick them and cash flowed them and turned them around. So I got really good at understanding how to operate properties and renovate them and buy them and sell them. And So it just seemed like a great, fun business, and it was. I really enjoyed it.
Yeah, good. I mean, it's good actually talking to other practitioners like you that actually do this or have done it. And it's very refreshing because there's a lot of folks out there that don't actually do the work, So just like you, I've done the same sort of thing. And when I started my journey a long time ago, but fast forward to what we got going on today. Certainly, we've got a bunch of market turbulence. In the green, we're talking about how I've broker friends calling me up all the time, asking me, "Hey, when are we selling our stuff?" Because there's no inventory, right? What are your general thoughts around where you see the multifamily space, where you see the office space? Because I know you're really big on office, you're really big on net lease too. Where do you see how things are headed in the next, say, 12 to 24 months in terms of the market, in terms of market movement or anything else like that? I mean, what are you seeing?
Well, one of the things that we're seeing is that the rapid increase in interest rates obviously has stalled transaction volume some, maybe roughly 50%. Less volume, but also it's interesting to see that these interest rates are still really low. When you think about historically where rates have been throughout my career, I can tell you at times when we could get a 12% interest rate loan, we were excited. So and interestingly, people made money. I mean, you can buy and sell and operate and do well in higher interest rate markets, and so it can be an advantageous market to be in at times. And I think the biggest thing that we're seeing a lot of clients with properties coming to grips with is that, look, these are the new rates. We've had really unbelievably low money, cheap money for a long time. That's gone. In most of our careers, we're probably not going to ever see that again. And pricing has adjusted depending on the property type, geographic location of things. Cap rates have increased, and I don't expect them to go back down. So we do have some sellers of apartments, net lease, and office things where they're realizing, what, this is a new market. I wrote an article the other day on pricing discovery for office properties around the country. And, one of the things I wrote in there was, how many people remember when a 10 cap was kind of a normal cap rate, was an average cap rate? Not that we're there on most properties, but, I think a lot of sellers are realizing, hey, this is the value. A lot of sellers are still selling from a profit position and taking profits and moving forward and not stalling because of the market. We've also been surprised at the lower cap rates that we've seen happen on some of the apartment projects we've been taking out with very recent closings. Some cap rates, I'm like, really? That low? Obviously, negative leverage, higher interest rates than the cap rates the properties are selling for. And I think it's because the properties were just in markets where, buyers could realistically and underwrite higher rents and increases. And I think depending on the property and location, a lot of people are still selling properties and moving. We've got an office property right now, I sound like my daughter, office property complex that we're taking out at 9.6 cap with 100,000 square feet of vacancy to rent up in a market with only 2.6% vacancy and an assumable loan at way low interest rates. And the sellers realize, hey, cap rates are higher. They've been around a long time. They understand rates are where they are, and they're probably not going to go back down for the foreseeable future. In fact, they may go up more. So, if you're a seller of especially a net lease or maybe in multifamily, you might see a higher price today, as we're doing this recording, than you will in 6 to 12 months. So I think you want to keep looking at doing deals and not just stagnate because the rates aren't what they were a year ago.
Yeah, it's the anchoring bias, right? People have been used to this 3% rate forever. And you're absolutely right. I mean, I've had other guys in the show here saying, yeah, rates are 12%, 14%. That was normal, so I think it still is too. But I think a big part of what you said is worth reiterating is that what market you're in matters too, right? Because I think that a big part of it, same as anything else, really, you have to consider what market you're in. I mean, I know you're in the Atlanta market. That office deal you just mentioned is in Atlanta, right?
No, actually, that portfolio is in Tennessee.
Oh, Tennessee. Okay, good. So Tennessee is also a hot market too. So there's certain markets, there's certain fundamentals when it comes to looking at assets that still, no matter what, always remains the same. You have to consider the market and consider where the rents are moving. Because it's there's some areas where they might be losing some potency. So like for instance, I'm hearing that that the influx of population in places like Florida and Texas have slowed significantly recently. Are you hearing the same sort of thing?
Yeah, I mean, they have slowed some, but it's still, they're getting a net positive, migration. So it's like, those are good markets and good points you're making. And I think, the other thing to think about is, doing transactions based on your own personal missions and not being stalled by interest rates being back closer to historic rates. I mean, he's like, we see a lot of value add investors that buy value add properties and they stabilize them. And then sell them. What would you not want to sell and go do another value add and keep rolling because rates are higher? I think you want to look at each situation. And my old pappy tell me if I was making a profit, I'm making a profit. I'm doing well. Don't look, you make decisions looking through the windshield, not through the rearview mirror.
Yeah. Yeah. That's the thing. I mean, there's always a deal in every single market, and it's a matter of just looking deeper and trying to find those deals because, to your point, interest rates are not going to go down anytime soon. We printed off $8 trillion over the past 3 years, and it takes a long time for that to get absorbed into the system, into the global system. As we still have the reserve currency status for the time being, it's for now. It's still there's going to be a waiting period. But I mean, I personally don't know if we're ever going to go to that 3% rate ever again. So if someone's sitting waiting by the sidelines, now's the time to do it. You have to keep looking for deals.
Yeah. In fact, in some cases it can be to your advantage, right? So if the cap rates are slightly higher, depending on the property and property type, then guess what? Your basis, your price per square foot, you're getting ins lower. And I've been in this business a long time, and a lot of times you look back at the historic history of your investments and what you've bought and sold. The original cap rate, may not be that important now, but it's really more the basis, right? Mm-hmm. Where you in at, 100 a foot or 200 a foot, and so if you have less buyer competition, and you can get in a better basis, then it can be, a good time when supply and demand is at your benefit. And I think that's part of what's happened in the single tenant net lease investment market, where we're seeing cap rates really adjust very marginally up, right? It's like the property type. It seems like the cap rates are still more stable than any other property type almost. And, I think that's, a testament to the strength of the tenants, the long-term leases and just that has less volatility and strong market.
Yes.
I mean, it has less volatility in poor markets, I should say.
Yes. Yeah. Well, I know what you meant, because we actually, as you know, we have a fund that acquires these net lease assets, and you're right. We have seen some steam come off of that, the cap rates there with some of these assets. One thing that we found that we've been able to do more recently is ask for seller financing. And it's one of those things that we're often surprised when these sellers are very, I'm not going to say they're pleased, but they at least hear us out, and they've even accepted 3 of our offers. So we've actually done 3 deals recently, 3 in a row, all seller financing deals. Because I guess they're seeing that obviously they can get the price that they want or closer to it, and they get to get tax advantages on their side. I mean, are you seeing more of that kind of stuff, going back to those types of fundamentals of seller financing, stuff that was happening a lot in the 80s, happening again today? Are you seeing that?
Yeah, absolutely. And it's a good point you made. In fact, I have 50 people here, and we meet once a week for at least 30 minutes and go over things that we think are helpful. And most recently, I went over several times ins and outs of owner financing wraps, unwrapping, subject to, how to have these discussions, who it's good for, and because it's coming back. And I tell you, in some cases, sellers really prefer it. They want to do an installment sale. They like the security of the property that they know. Where are they going to get, if they're going to finance it at say 5 or 6%, that's a good safe return for them, right? And an installment sale. So I think there's a lot of sellers that it makes sense, especially if they're, in the upper ages of their investment world, right? And we've seen sellers. I had a quick example I thought was funny. I've been in the business about 5 years as a broker. So, of course, I knew everything. And I brought an offer to a restaurant seller, vacant restaurant, and it was cash offer. My buyer's going to get a loan. And he said, well, I'm going to owner finance it. And I said, because I knew everything, I said, no, this is better. This is, you're going to get it all cash. He said, no, I'm going to owner finance it. And after one more argument, he said, look, Michael, your buyer's not going to get this property unless I owner finance it. And so I said, why? He said, well, Mike, your guy's going to put 25% down. I'm going to finance a balance. I've done that 3 times and I've taken the property back. And he said, so, I still own the property again, and I'm not selling it to him for all cash. It's going to be under finance because he's going to not pay his sales tax, or he's going to start drinking the liquor, and something's going to happen, and I'm going to take it back. Now, so I did that sale, owner financed, and he did not lose it. He did well. My buyer did. But, some people, especially in states where the foreclosures are a lot easier to do, owner financing, even for a seller, can be a great move.
Yeah, that's right. And I think that in the net lease world, especially, what we're finding is a lot of people that want to get into the real estate game, they can't really find decent multifamily or even office for that matter. Office right now, that's a whole different story. But oftentimes, net lease, especially investing in a fund or something like that, is a great way to kind of break in and still enjoy some significant, steady stream of income while we work through this mess of an economy that we currently have right now, right? Because it's very, very steady. It's corporate backed. It's a great deal. So I'm assuming you're still seeing a great deal of activity on your net lease side. So I know you're really big on the net lease business side, right?
Yeah, we do. Nancy Miller leads our net lease team here, and it's still a strong market. In fact, the supply and demand is such that it's still a good time for sellers on net lease properties or sell lease backs for companies that, operate and own the real estate and operate their business there. So I think it's a strong market and there's not enough properties to choose from. So if you're a seller in the net lease, it's probably a good time to sell, especially if you're reading the tea leaves that say we're going to have more increases on the interest rate.
Yeah, that's
maybe
right.
you sell today and not a year from now.
Oh no, rates are already going up. I mean, I think they're saying 0.25 or half a basis point. That's supposed to be happening here anytime now. So we're actually locking in one of our refis on one of our multifamily deals currently. So yeah, it's happening. But at the same time too, you get these big office REITs that are turning over right now. I mean, what was it last week? Was it BlackRock or Blackstone? One of these guys? Maybe it wasn't those guys, but someone turned over their entire office portfolio on like millions of square feet gone. It's getting really ugly out there for a lot of office space, especially. And I don't know if you have been taking on any of that type of stuff. I know you talked about one earlier, but on a national basis, are you seeing more of this kind of stuff happen?
Yeah, you are. And to your point earlier, on all properties, it's really specific to the location and the asset and its competition and the leases and tenants in it. But yeah, we're seeing activity on office transactions slow down probably 50-60%, and we're still seeing transactions. But yeah, it depends on the density too of the market. Is this a CBD and a high rise and a really dense environment, or is it more of a suburban office? Is it more of a drive-to kind of property? Are the tenants smaller tenants that are smaller companies that are really in their office working day to day? Or is it these big company tenants where they're trying to treat people all over the country or over the world the same? They're having trouble hiring. I think the office market is going to struggle for another year or two until the Fed kills the economy enough to kill jobs. And I think, as long as the employers can't get people back because they'll quit. And as Elon Musk says, go pretend to work somewhere else or get back in the office. Until that job market changes, employers have struggles getting the ones who want to get their folks back in for the benefits to the employees and to the employer, they have trouble getting them back in if they can just go get a job and, in their pajamas, from a competitor. But when the job market does change, the office market will strengthen. Some of the properties are getting converted to multifamily residential, like you guys have done or doing. Some of them are going to get torn down. Some be more mixed use development. So I think in the new supply will soon start. Will start slowing. There's still new supply in the market now for the most part because of it takes so long to get something from conception to delivery, right? But you'll start seeing supply dwindle down and prices coming in line. We're seeing cap rates on the office world about 200 basis points higher than they were a year ago. And we don't expect them to change for a long, long time, so the values are where the values are. So some people are buying and selling and trading. And I think it's a good opportunity for investors. There's a lot of contrarian investors who've done well over the years, where I call them in a good market. And they say, Michael, it's really cute. Appreciate you calling me. But, we don't buy when the market's hot. We only, buy when there's a little bit of blood in the street. Well, here you are in office. It's a really good time. You might get some really good properties where you have less competition. You might get some really good opportunities because there's less lenders involved. There's still lenders doing loans. They're going to look at them more carefully, and they should. But I think it's a good opportunity for companies that use space to look at their opportunities to lease or to buy. And I think it's a good opportunity for getting into some of these office investments because there's just few competition. I mean, this deal that we have at 9.6 cap with all the vacancy and that you can lease up in a market that's that tight, it's just an assumable loan. It's a remarkable opportunity that doesn't come along. You just don't see those opportunities, right? So I think you really still want to be active in an investment world and consider buying and selling and making moves, being a bit of a contrarian when it makes sense.
Yeah, absolutely. Hey, listen, there's deals in every single market. My buddy was approached by a bank in Dallas. That's where he's based out of. The bank took a building back. They actually told my buddy here, we'll give you 100% financing on this deal. This is a $30 million deal. We'll give you 100% financing on this deal. Just take it. Take it. It's like that's what's happening now. So I think the blood in the streets, like you mentioned a second ago, is very real, and it's starting. I think it's starting to happen. Only now it's starting to happen. I don't know if they're quite there yet. I mean, I still believe it. There's still a lot of runway to go, man. That's what I really do believe that. I mean, it's still going to get a lot uglier before it gets better. That's for sure.
Yeah, I think we'll see more short sales, more note sales. We're working on some note sales on office buildings, and some foreclosure stuff already. So yeah, I think we'll see more of it. And so a lot of investors, they're wringing their hands. They're like, okay, this is good. This is time to be buying. What I like to tell folks who aren't in the real estate business, and they ask me about buying and selling and timing. I say, well, here's a rule of thumb. If you're at a cocktail party and everybody's talking about how great the market is and they're flipping contracts on houses and condos, he's selling. And if you're at the cocktail party and people talking about how bad the real estate market is, you should be buying.
You should be buying. That's right. I mean, and we talked about this in the green room a little bit, is that right now there's still this housing shortage. There's this constant beating of drums here of housing shortage. And I'm looking around like, there's certainly no housing shortage for A-class properties here. And certainly the luxury market doesn't seem to have a problem at all. A lot of luxury stuff here. I'm looking out, looking at my high rise here. I see luxury all over the place out here. And there's still availability. It sounds to me like it's the C-class or even low income type scenarios that are really experiencing this shortage, only because when you have inflationary pressure like we've been having today, certainly everybody feels it, but the ones that feel it the most are the people that are hitting the streets every day and working. Those are the ones that feel it the most, right? So, I mean, what are your general thoughts around that in terms of, like, say, acquiring these assets and converting them? What would you convert them to if you were going to do such a thing?
I mean, like converting office?
Yes.
properties to other uses? Well,
Yeah.
residential is probably the one that most comes to mind. You guys are doing some of that. I did a show on it last week. And I think, if you got a small enough floor plate, or maybe you got a building with some historic nature to it, maybe it's got some walkability, and in a market where the multifamily conversion makes sense, your basis is low enough on the office building to make it make sense. That can be a great use, because one of the things you do is you save time, right? By having that superstructure there, utilities there, maybe parking's there. I mean, you have a lot of things that could save a lot of time. If you could save a year of interest carry, that can make a big difference.
That's right. And not to mention too, you're also cutting down the cost of the exterior build out. Just doing the interior also save a lot of money too. And I mean, the reason I'm asking, obviously in the green room, we're talking about doing some sort of LIHTC or low income tax credit housing type scenario. I know you're an expert on that kind of stuff. So the way I see it, again, it's the ones that are feeling the most amount of pressure these days for housing are those folks and the C-class workforce type of housing. I guess what are your general thoughts around taking these types of offices and converting them to a multifamily type scenario? Do you think there's going to be problems with NIMBY? No, not in my backyard. Do you see any of that stuff happening? I don't know how much exposure you've had to doing those sorts of conversions before.
Well, I think the biggest challenge really is finding a suitable asset where you can get a low enough basis and that has the right market to be adding more multifamily. Right. And it has the floor plans small enough. It has some windows, has good windows. Right. And that sort of thing. I think so. It's more challenge, I think, just to find the right asset and base and price bases than anything else. But there could be entitlement issues. But I think it's more of just finding the right properties.
Yeah. Well, I mean, it's in development. I mean, I've done enough development now to know that, it takes a while. It takes a long time to really nail all that stuff down. To your point earlier about how much time it takes to put these deals together. You're looking at least a year once you identify an asset from at best. But by the time you identify and close it to actually swinging hammers and start building, it's probably 12 months out. So it takes a while to find that asset. No, I totally agree. But at the same time too, there is still definitely a housing shortage, and that C-class asset is still very sought after. Still very sought after these days. I mean,
yeah, and I think that's why the cap rates haven't changed as much on multifamily. I mentioned office changing, about 200 basis points on average. Mm-hmm. Some maybe as low as 50 basis points, depending on the lease and the tenant, right? And some, much higher than that. But I think multifamily, for the most part, if you look at averages, hasn't changed as much as that. Maybe it's 100 basis points, but we're the ones that we're selling, it seems like they've only changed about 50 basis points. Maybe that's because the complexes we're selling are in the Southeast, which are, showing promising growth and demand. And to your point, a shortage. And so they're still banking on rent increases, not the 10% or so that they've enjoyed for many years, a year of rent escalations, but still some escalations that are maybe more normal market free or what have you.
Yeah. So now, what are your general thoughts then? Here we are, we're at Q1 of 23, and Sam Zell, a lot of the big real estate guys, they keep saying that this recession that we're experiencing, I think we're in a recession, but the classical definition of 2 negative quarters of GDP. They're saying, though, that towards the end of this year, towards the end of 23, we're going to have a full-scale recession. Rates are going to continue to go up. That's what the general consensus is. Do you agree with that consensus, or do you think that they're just people just making things out to be very, very dire? Like, what do you think?
From a broker's point of view that's just been in the business for a while, I think it seems like the Fed just wants to crash the economy to get inflation, and they feel like that's the only tool they have to fight inflation. But I think there's other tools they should be considering, less regulations, open up the pipe, open up the fuel. If we can get fuel prices down, that reduces a lot of prices on everything. Has to be delivered with some type of fuel, right? So I think they're just going to continue to increase till they do create a recession and job issues, unfortunately. So yeah, I expect interest rates to still tick up, not as much as they have, but continue to tick up. It's like they started too late, and they're changing too fast, in my opinion. But I think, what we can bank on is what we know today, right? And if you have a property that you want to sell and you think rates are going to go up and you're dealing from a profit, you do value add and sell stabilized. Keep doing what you do. Rates aren't going to come down. Don't let this freeze you. Think long term. And if you're acquiring properties, I think the biggest mistake I've seen investors make throughout my career is not buying a property because they just didn't. It was a good property and they didn't buy it because they thought it was a little too high, or their interest rates were a little too high, the cap rate was a little too low. And then, but I look at the properties I own that I own them free and clear, and it really doesn't. When I look back, it doesn't matter what the cap rate was. It doesn't matter what the interest rate was then. Most real estate's a fairly long-term hold. And if it is, it's getting in good properties, right? In a good basis, can be more important than the cap rate du jour. Yeah. Yeah. Well, hey, I'm a long-term hold guy too. That's a strategy. It's a smart strategy, if you ask me. It's one that Warren Buffett uses, and he was one of the richest men in the world because of it. So, I mean, there's a reason why he does that, right? So, yeah, but I think part of it has to do with people just want to get in and out, and they're always like, they're so focused on the cap rate, and the cap rate is nothing more than one metric, especially when you're talking office or multifamily. It's one metric that of a very complex deal, as opposed to like net lease, where it is the metric, right? So it's two different things. That's a whole other show. Right. Though, right? So we talked a lot about stuff here today. Someone's listening right now, and they got some insight on where the economy is going. What sort of bulletproof advice would you offer that person if they were like sitting on the fence about, say, doing a deal or something like that? I would say just don't become frozen. Continue to focus on what you do. If you're a broker, focus on what you do. Investor, if you're raising money, if you're a limited partner, just keep doing what you do. Keep looking at deals. And I think for any lenders that might be tuning in, I think this is an opportunity for you to build probably some of the best relationships in your career. Probably do some of the safest loans you've ever done. Because you don't have as much competition on the lending side. You have buyers who are underwriting more carefully, and you don't have the rate risk at maturity, right? Because that, which is what some lenders are experiencing now at maturity in borrowers, right? Where rates are so much higher, they can't get the debt coverage ratio to refinance these loans. So I think lenders, it's a good opportunity to build relationships. I know I've seen it, in previous downturns. I built a great relationship with BB&T during the last downturn, where they just came in and just did things that the other big banks just weren't doing and were making mistakes. And I've worked with hundreds of banks doing REO and short sales and foreclosures, and I've seen what they do right and wrong in doing loans, and also in when they have to foreclose. I think it's a good time to just not and be out there and be active, because you could look back at your history when you're at retirement age one day and looking back, wow, that property I bought when everybody was kind of frozen and not doing deals was my best property. Man, I've got it. I found it. If you're a tenant or a user, oh man, it's a wonderful opportunity. If you run a business, to be looking at your business, maybe to do a sale leaseback because of the lack of opportunities, the lack of supply and demand issue, or your office to buy or lease buildings. I think it's a great opportunity for users and occupiers of space.
Yeah, absolutely. Every market has a deal. Every single market has a deal.
Yeah, that's true.
Excellent. All right, guys. Well, if you want to reach out to Michael, you can reach him via his website at bullrealty.com. Go ahead and check out some of the properties they have on their site as well. If you are interested in jumping into this business, reach out to Michael and his team. They can certainly help you out in terms of lining up with some remarkable deals. Thanks for tuning in, guys. I'll see you in the next episode. Take care.
You've been listening to the Bulletproof Cash Flow Show. We hope you've enjoyed the show. We know we had fun. Make sure to visit our Apple Podcast page and leave us a 5-star review. We hope you've gotten some useful and practical information from the show. For real estate coaching, events, and resources, hit up bulletproofcashflow.com. Till next time.
No information in this episode should be considered specific, personal, or professional advice. Any investment opportunities mentioned on this show are limited to accredited or sophisticated investors. Any investments will only be made with proper disclosure and subscription documentation and subject to all applicable laws. Please consult an appropriate tax, legal, real estate, financial, or business professional for individualized advice.